After the rally in financial markets at the end of 2023, we have seen a correction kicking in at the beginning of this year. And looking at the S&P 500, which made already another all-time high, you could think that this correction has already ended. We don't think so. And the reason for this is that inflation is still an issue for financial markets. Why? We have seen the big fall in inflation in the second half of 2023, and we expect that inflation will remain now stubbornly high in the first half of this year. This has to do with several factors. On the goods prices side, we think that the disinflationary impact from falling commodity prices is fading out. Furthermore, higher transportation costs, and that reflects geopolitical risks as in the Red Sea, or climate risks coming from a reduction in the water of the Panama Channel, that transport costs are likely to be higher and likely to feed through to goods prices. But the main factor for higher inflation is service price inflation. Here in the US, the ongoing strong labor market is likely to keep wage pressure high. In Europe also, we have high demands from the trade unions, which are likely to keep the pressure on the wage side high as well. On top of this, we expect that administered prices are likely to go up. And furthermore, the rents component in the HICP is likely to increase. There are two reasons for this. One reason is that the indexation of many rents contracts is likely to mirror the increase in inflation that we have seen last year. On top of this, in some places, particularly in Germany, we have a shortage of new housing, which is likely to propel rents. Altogether, in our view, inflation is likely to stay higher, and central banks are not likely to go ahead with very early rate cuts. We think that the Fed is going to cut from June onwards, and that the ECB will start cutting rates in September. That's somewhat earlier than we thought before, but it's way later than the market is pricing in currently. So with the focus on inflation, the data from the economic side are likely to be not in the focus of market participants, unless there are big swings on the up or the downside. But what is likely to come back is the political risks. We are getting closer to the elections of the European Parliament, and there it seems that in many countries, right-wing popular parties are gaining shares of votes. On top of this, in the US, it seems that the former President Trump is likely to be the nominee for the Republican Party for the upcoming election. So all of this together suggests that the geopolitical risks are likely to come back on the agenda and are likely to lead to higher risk premia in the market. Taken all together, we expect an ongoing correction of the markets in the coming weeks, but in the second half of the year, when the economy is likely to gain some steam, inflation is continuing to come down, and central banks are actually cutting rates, there will be an improvement in the market sentiment, and then we expect not just in terms of lower yields, but also in terms of increasing equity markets, a better outlook for financial markets.